In this video, we are going to walk through how to calculate gross margin percentage. The gross margin percentage calculates the ratio of a company's gross margin to its net sales. It measures the amount of gross margin or gross profit being earned on each dollar of sales. Recall that gross margin is calculated as a company's net sales minus its cost of goods sold expenses for the period. This ratio is also referred to as the gross profit margin or gross profit percentage. When interpreting the gross margin percentage, it is better to see a consistent or increasing trend. Consistent or increasing gross margin percentages indicates the company is efficiently managing its cost of sales expenses, which means that the company is earning more profit on each product sold. Or the company could be growing sales but keeping its cost of goods sold expenses constant. A decreasing return on sales ratio indicates the company is not managing its cost of sales efficiently and could indicate financial trouble. The gross margin percentage is always more useful when it is used for comparison by itself. The gross margin percentage can be compared to the gross margin percentage for companies within the same industry. A company's gross margin percentage can also be analyzed over time. Generally, it is desirable to see a gross margin percentage that is increasing or at least remaining stable over time. The gross margin percentage is calculated by taking the company's gross margin and dividing by net sales. Both of these amounts are found on the company's income statement. Here we have 3 years of gross margin and net sales amounts listed for a company. We're going to calculate the gross margin percentage for each year. For the most recent year, we would take the gross margin of $472,500 and divide by the net sales of $787,500 to get a gross margin percentage of 0.6 or 60%. That means that for every dollar of sales revenue, the company generated 60 cents of gross profit after its cost of goods sold expenses. For 1 year earlier, the gross margin percentage is 0.55, which is the gross margin of $357,775 divided by net sales of $650,500. For the earliest year, the gross margin percentage is 0.49 or 49%, which is calculated by dividing the gross margin of $269,500 by the net sales of $550,000. Gross margin percentage has steadily increased from 0.49 or 49% in the earliest year to 60% by the most current year. This is a sign that the company is growing sales and also more efficiently controlling its cost of goods sold expenses, which is a positive trend. That's it, we are done. This video was created and narrated by Dr. Wendy Tietz and is part of the Accounting Skill Builder video series. See accountingisanalytics.com for additional faculty and student resources.